So the markets have steadied for now at least. Indeed, there's very little red so far on the European bourses this morning. No, the various debt crises haven't been solved, merely put to one side as China posted GDP figures that show an economy still roaring ahead. Andrew Robertson reports.
With Australia so heavily leveraged to the fortunes of China, the Chinese economic growth figures are eagerly awaited in this part of the world. And financial markets liked what they saw this time round, the Australian dollar rising and the share market firming as the numbers were digested.
China is what is really driving the strong part of the Australian economy. It's the thing that is not only giving us the growth that we've got, but it's actually changing the structure and nature of our economy.
At an annual growth rate of 9.5%, the Chinese economy beat economists' forecasts in the June quarter, but importantly, there's a healthy slowing.
A normal growth rate in China is somewhere around 9 to 10%. Now, a year or so ago, it was way above that. And what the Chinese authorities have done by putting the brakes on, partly to take pressure off inflation, is that they've managed to get it to slow down back into what I think is a more sustainable pace.
Looking through the headline GDP figure, Shane Oliver sees plenty of evidence that the Chinese economy remains on a very firm footing.
Industrial production up above 14%, retail sales around 17%. That's pretty good growth, and it's a great news story for Australia. Yes, there's all these concerns about Europe and about the US, but the Chinese economy is still growing strongly, and that means good demand for our commodities.
It also might allay fears that 5 interest rate rises in the last year could have knocked the wind out of China's economic sails.
It looks as though monetary and fiscal consolidation has moderated the economy into a soft landing rather than a hard landing, and it looks as though there's very strong momentum in the economy, but not so strong perhaps that you'd be still worrying about inflationary pressures from a growth perspective.
But at nearly 6.5%, inflation remains stubbornly high, something Nikki Hutley says is not helped by China's artificially low currency, which continues to be pegged to the greenback.
Last year, after the G20, they said that they would unpeg and have a little bit more freedom. We haven't seen a huge amount of that come to play, and that is an issue for them that they have to deal with, but it's as much a political as an economic one.
It's growth like that unveiled in the June quarter, which had the Treasurer eulogising about the Chinese economic miracle in an address to students at the Australian National University in Canberra.
By the end of this decade, China could well pass the US as the world's single largest middle-class consumer market.
Which, according to Mr Swan, will mean in years to come it won't just be the resources sector which rides on China's back.
China's growing middle class will generate new consumer markets and new opportunities for Australian business in tourism, advanced education, and of course other services that Australian companies successfully sell to the world today.
That process has already started, with 57 million Chinese tourists travelling overseas last year. The challenge is to persuade as many as possible to come to Australia.